The biggest mistake of my career wasn't buying a bad stock, it was selling a good one. I sold Walmart after it went up 5 times. I thought I was a genius. If I'd held it for 10 more years, it would have been a 50 bagger. 50. That mistake cost me hundreds of millions of dollars. And it taught me the most expensive lesson in investing. Doing nothing is often the hardest and most profitable strategy of all. Let me tell you about the day I made one of the stupidest decisions of my investing career. It's 1985. I'm managing the Magellan Fund. We own Walmart. We bought it early when it was still a regional chain, and over 3 years it's gone up 500%, 5 times our money, a 5-bagger. I'm sitting in my office looking at the position, and I'm thinking, this has been a great run. We've crushed it. Maybe it's time to take profits, lock in the gains, move on to the next opportunity. So I sold most of the position. Not all of it, but most of it. I kept a small stake, maybe 10% of what we originally owned, but the bulk of the investment, gone, sold, profit realized, pat myself on the back, and I felt smart. I felt disciplined. I felt like I was managing risk, taking chips off the table, being prudent. Then I watched what happened next. Over the next 10 years, Walmart went up another 10 times. 10 times from where I sold it. That 5-bagger I was so proud of, if I just held it, it would have been a 50-bagger, 50 times the original investment. Let me put that in real numbers. We had about $50 million invested in Walmart when I sold. That turned into $250 million, and I thought that was incredible. And it was, but if I'd held, that $50 million would have become $2.5 billion, $2.5 billion with a B. The difference between $250 million and $2.5 billion is the cost of impatience. That's the tuition I paid to learn one simple lesson. When you find a great company, doing nothing is not lazy. It's a strategy. Here's what nobody tells you about investing. The hardest part isn't finding good companies. It's sitting still after you found them. We're wired to do something. Our brains reward action. Buying feels productive. Selling feels smart. Trading feels active, engaged, alive. But sitting still, holding a winning position for years, that feels boring, passive, like you're not actually investing. This is exactly backwards. The greatest fortunes in the stock market were made by people who found great companies and then did absolutely nothing for decades. Warren Buffett bought Coca-Cola in 1988 and still owns it. He bought American Express in the 1960s. Berkshire Hathaway investors who bought in the 1970s and held are worth hundreds of millions, not because they were smarter than everyone else, because they were more patient. I learned this lesson the hard way multiple times because apparently I'm a slow learner. I sold Home Depot too early. I sold Fannie Mae too early. I sold dozens of stocks that went on to become 10-baggers, 20-baggers, 50-baggers after I exited, and every single time the reason was the same. The stock had gone up. I felt like I should do something, so I sold. But here's the question I should have been asking. Has anything actually changed? Is the company's story still intact? Is the business still growing? Is management still competent? Are customers still buying? If the answer to all those questions was yes, then selling was stupid. I was selling based on price movement, not business fundamentals. I was reacting to the scoreboard instead of watching the game. Let me be very clear about something. When I say I regret selling Walmart, I don't mean I should have held it forever regardless of what happened. I mean I should have held it as long as the story was working, as long as the thesis was intact, as long as the business was growing. When you buy a stock for the right reasons, you should only sell it when those reasons change. Not because the stock doubled, not because you're nervous, not because you want to feel like you're doing something. You sell when the story breaks. That's it. That's the only reason. And in 1985, when I sold most of our Walmart position, nothing had changed. The story was still working. Sam Walton was still opening stores. Customers were still flooding in. Revenue was growing. Margins were expanding. Everything that made me buy it was still true. I sold anyway because I couldn't help myself. This is the curse of active management. You feel like you have to do something. You have reports to write. You have meetings to attend. You have a board to answer to. You have quarterly performance to justify. But the best investment decision is often the decision to do nothing. And that's almost impossible for most people to accept Now, before you think this is just me beating myself up about the past, let me tell you why this matters for you. Because you're going to face this exact same decision. You're going to buy a stock, it's going to double, and you're going to feel an overwhelming urge to sell. And if you do, you're going to miss the real money, because the real money is never made in the first double. It's made in the second, the third, the fourth double after that. Let me tell you about one I got right, because I don't want you to think I'm just the guy who sold everything too early. Sometimes I learned, sometimes I held on, and when I did, the results were extraordinary. Home Depot, 1984. I heard about this company from several people. They kept saying, Peter, you have to see this place. It's incredible. It's like a warehouse and a hardware store had a baby. Everything you need for home improvement all in one place at prices that crush the competition. So I went. I visited a Home Depot on a Saturday morning, and what I saw was remarkable. The parking lot was completely full. I had to circle twice to find a spot. I walked in and the place was packed. Contractors with shopping carts full of lumber, homeowners wandering the aisles with their project lists, employees in orange aprons helping customers find what they needed. I spent 2 hours there just watching, observing, taking notes, and here's what I saw. This wasn't just a store, this was a destination. People were driving from 20, 30 miles away to shop here. They were spending hundreds of dollars per trip. They were coming back every weekend. This was the beginning of something big. We bought the stock early 1985. The stock was around $10 per share, adjusted for splits. First year, it doubled. We're at $20. 20-bagger potential? No. 2-bagger reality. Nice, but not life-changing. Some fund managers would have sold here. We doubled our money in a year, take profits, de-risk. I didn't sell because the story was still working. Home Depot was opening new stores. Every store was profitable. Customer satisfaction was high. The model was replicable. Second year, it went to $40, 4-bagger total, 4 times our money in 2 years. Now, the pressure to sell was intense. People on my team were saying, Peter, this has been an incredible run. We should lock this in. What if it crashes? I didn't sell because the story was still working. Third year, $80, 8-bagger. Fourth year, $160, 16-bagger. Fifth year, $320, 32-bagger. Let me pause here and let that sink in. If you invested $10,000 in Home Depot in 1985 and you held it for just 5 years, you had $320,000. But here's the really crazy part. I still didn't sell because the story was still working. Year 10, 1995, the stock was at $450 per share, 45 times our original entry price. That $10,000 was now $450,000. Year 15, 2000, peak of the tech bubble, Home Depot was at $700 per share, 70-bagger. That $10,000 was now $700,000. Now, did I hold all of it for the entire 15 years? No. I retired from Magellan in 1990. The fund trimmed positions over time. We took some profits along the way. But the core lesson stands. If you'd bought Home Depot in 1985 and just held it, ignoring all the noise, all the volatility, all the market crashes, all the recessions, you would have made 70 times your money. 70. And here's what's critical to understand. At every stage of that journey, there were excellent reasons to sell. After the first double, we doubled our money, bank it. After the 4-bagger, it's overvalued now. PE ratio is too high. After the 8-bagger, this can't continue. Trees don't grow to the sky. After the 16-bagger, we're being greedy. Take the money and run. Every single one of those statements sounded reasonable, smart even, prudent risk management, and every single one of them would have cost you tens of thousands, hundreds of thousands, eventually millions of dollars. Because the story never broke. Home Depot kept opening stores. Customers kept shopping, revenue kept growing, the business model kept working. That's the test, not the price, not the valuation, not what some analyst on TV says. The test is the story still working? Let me tell you what the story means. When I bought Home Depot, the story was this. Americans are moving to the suburbs. They're buying houses. They want to do their own home improvement. But the local hardware stores are small, expensive, and limited. Home Depot solves this by offering massive selection, low prices, and a one-stop shopping experience. As they open more stores, they'll gain economies of scale, which will let them lower prices further, which will attract more customers, which will fund more store openings. Virtuous cycle. That was the story. And that story played out exactly as expected for 15 years. Actually, it played out for 30 years. Home Depot is still a massive, successful company today. As long as that story was intact, there was no reason to sell. The fact that the stock went up was evidence that the story was working, not a reason to exit. This is what most investors get backwards. They buy a stock based on a story, the stock goes up, and they sell because it went up. They're selling the evidence that they were right. Think about how insane that is. You do your research, you identify a great company, you buy it, the company does exactly what you expected, the business grows, the stock rises, and you sell. You sell because you were correct. That makes no sense. You should sell when you were wrong, when the story breaks, when the thesis fails, when the business deteriorates. But if the business is thriving and your thesis is playing out perfectly, why would you sell? The only answer is psychology, fear, greed, impatience, the need to do something. And those are terrible reasons to make financial decisions. I know what some of you are thinking. Peter, that's easy to say in hindsight. How was I supposed to know Home Depot would become a 70-bagger? Maybe it would have crashed. Maybe I would have lost everything. Fair question. Let me show you exactly how to know whether to hold or sell. It's not complicated, it's just discipline. Here's the system I developed after making too many expensive mistakes. I call it the story test. And it's the only framework you need to decide whether to hold or sell. When you buy a stock, you're buying it for a reason. Maybe it's a growing company in an expanding market. Maybe it's a turnaround story. Maybe it's a dividend payer with stable cash flow. Whatever the reason, you have a thesis, a story about why this company will succeed. Write that story down. 1 page, in plain English. Include 1. What does the company do? Not in technical jargon, in simple language. Home Depot sells home improvement products through large warehouse stores. 2. Why will they succeed? Americans want to improve their homes. They want selection and low prices. Home Depot provides both. As they open more stores, they'll gain purchasing power with suppliers, which will let them lower prices further, attracting more customers. 3. What could go wrong? A competitor could copy the model, a recession could hit, and people could stop spending on home improvement. Management could screw up the expansion. The stores could be too expensive to operate profitably. That's your story. That's your thesis. Write it down, date it, put it in a file, then every 6 months take it out, read it, and ask yourself, is this story still true? Not, has the stock gone up? Not, am I up 50%? Not, should I take profits? Just, is the story still true? For Home Depot, every 6 months from 1985 to 2000, the answer was yes. They were opening stores, customers loved them, revenue was growing, management was executing well, no major competitors had successfully copied the model. The story was intact, so there was no reason to sell. The fact that I was up 500% or 1,000% or 7,000% was irrelevant. What mattered was whether the business was performing as expected. Now let me give you a counterexample, a time when the story broke and I should have sold Kodak, early 1990s. The story when I bought it. Kodak dominates film photography. Everyone takes pictures. Film is a consumable product. People have to keep buying it. Kodak has brand loyalty, distribution, and economies of scale. As emerging markets grow, more people will buy cameras and film. Kodak will benefit. Great story, logical, compelling. For several years it worked. Kodak made money, the stock did fine, everything was on track. Then, mid-1990s, something changed. Digital cameras started appearing. They were expensive and low quality at first. Most people dismissed them, including Kodak's management. But I started seeing digital cameras in stores. I started hearing people talk about them, and I realized this is a threat. This could destroy film. The story was breaking. The thesis was failing. Film wasn't a permanent consumable. It was a technology that could be replaced. That was a signal to sell. Not because Kodak's stock had dropped, it hadn't yet, but because the fundamental story, the reason I bought it, was no longer true. I didn't sell fast enough. I held on too long, and I lost money. This is the story test. You sell when the story breaks, not before, not because you're nervous, not because you made money. You sell when the reason you bought it is no longer valid. Let me give you the 4 signals that tell you the story is breaking. Signal 1, management changes and the new team has a different vision. If the founder who built the company retires and is replaced by a professional CEO who wants to transform the business, be nervous. Transformations usually fail. The original vision usually worked for a reason. Signal 2, competition intensifies and your company is losing market share. If 5 years ago your company had 40% market share and today it has 25%, something's wrong. Competitors are winning. Your company is losing. The story is breaking. Signal 3, the company stops growing revenue, not for 1 quarter. But if revenue has been flat or declining for 2 years, the growth story is over. Maybe it's a mature business now. Maybe it's in decline. Either way, if you bought it for growth and growth has stopped, the story has changed. Signal 4, the core product or service becomes obsolete. This is what happened to Kodak. Digital cameras made film obsolete. When the world changes and your company's product is no longer what customers want, it's over. Sell. But if none of those 4 signals are flashing, if the company is still growing, still gaining share, still innovating, still executing, then hold. Ignore the price. Ignore the pundits. Ignore your emotions. Just hold. This is the art of doing nothing. It sounds passive, it sounds lazy, but it's actually the hardest thing to do in investing because your brain is screaming at you to take action, to lock in gains, to move to the next opportunity, to do something. You have to fight that instinct. You have to sit on your hands. You have to trust the process. And if you do, the rewards are extraordinary. Now let me show you exactly how long you should hold a stock. Because this is where most people get confused. They think there's some magic number. Hold for 5 years. Hold for 10 years. That's nonsense. You hold as long as the story works. Could be 3 years, could be 30 years. Let me show you how to think about this. Every company goes through stages, and you need to know which stage your company is in because that determines how long you should hold. Stage 1, startup, years 1 to 3. This is the highest risk, highest reward phase. The company is proving its concept. It's not profitable yet. It's burning cash. It might fail. If you're investing here, you're making a bet, a big bet. Most startups fail. The ones that succeed can return 100 times or more, but this is not where I invest. Too risky, too unpredictable. I don't have an edge in evaluating whether a brand new company with no track record will succeed. I leave this stage to venture capitalists and speculators. They can afford the losses. They're built for it. Stage 2, growth, years 3 to 7. This is my sweet spot. This is where I made almost all of my money. The company has proven the concept. It's profitable or close to profitable. It's expanding rapidly, opening new locations, entering new markets, gaining share. Revenue is growing 20%, 30%, 40% per year. The story is working. The model is replicable. Management is executing. This is where 10-baggers live. This is the stage where you find Home Depot, Walmart, Starbucks, Netflix, and this is the stage where you must hold because this is where the exponential growth happens. If you sell after the stock doubles in the growth stage, you've missed 90% of the returns. How long does the growth stage last? Usually 5 to 10 years, sometimes 15. As long as the company can keep expanding, keep gaining share, keep growing revenue at 20% plus annually, you're still in the growth stage. Don't sell because the stock is up. Sell when the growth slows. When revenue growth drops from 30% to 10%, that's the signal that the growth stage is ending. Stage 3, maturity, years 7 to 15. The company is big now. Maybe they have run out of new markets to enter. Maybe they have saturated their niche. Maybe competition has caught up. Revenue growth slows from 30% to 10%, still growing, but not explosively. The stock still goes up, but not as dramatically. This is still a good investment if the company is well managed. It's just not a 10-bagger anymore. It's a steady, reliable grower. Many investors sell at this stage, and that's fine. If you bought in the growth stage and held through maturity, you've already made great returns. Moving to the next growth stage company makes sense, but you don't have to sell. If the company pays dividends, if the management is good, if the balance sheet is strong, holding through maturity is perfectly fine. Stage 4, decline, years 15 plus. This is where the story ends. Revenue is flat or shrinking. The company is losing market share. New competitors are taking customers. Management is cutting costs and buying back stock because they have no growth opportunities left. This is when you sell, not before, but definitely now. The mistake most investors make is selling too early. They sell in the growth stage because the stock doubled. They should be selling in the decline stage when the story breaks. But they do the opposite. They hold declining companies out of loyalty or hope, and they sell growing companies out of fear or greed. Get this backwards and you lose. Get it right and you win. Here's the simple rule. Buy in growth, hold through growth, sell in decline. That's it. That's the entire strategy. Home Depot in 1985, growth stage, hold. Home Depot in 1995, still growth stage, still hold. Home Depot in 2000, starting to mature, but still growing. You could hold or sell and find the next growth story. Either is fine. Home Depot in 2025, mature, solid company, but not a 10-bagger anymore. If you're hunting for 10 baggers, sell and find the next Home Depot. The point is this: the stage of growth determines the holding period, not the calendar, not your emotions, not the stock price. The business stage determines the investment stage. All right, now we get to the really hard part, because understanding these stages intellectually is easy. Actually sitting still and doing nothing while the stock bounces around, that's nearly impossible for most people. Let me show you how to master the art of inactivity. The hardest skill in investing is not picking stocks. It's not analyzing companies. It's not understanding financial statements. The hardest skill is doing nothing after you've picked a good stock. Because once you own a stock, the market will torture you. It will test your conviction every single day. The stock will drop 10% in a week, and you'll panic. Should I sell? Is the story breaking? Am I losing all my gains? The stock will double in a month, and you'll get greedy. Should I sell? Lock in profits? This can't last. The market will crash 20%, and you'll be terrified. Should I sell everything? Get to cash? Wait for the bottom? Every day the market is screaming at you to do something. Buy, sell, trade, move. And the correct response almost always is nothing. Do nothing. Just sit there. Hold your stocks. Ignore the noise. Here's what I learned over 30 years. The investors who made the most money were not the smartest. They were not the most active. They were not the best traders. They were the most patient. They were the ones who bought good companies and then went to sleep for 10 years. John Templeton bought stocks and held them for decades. Warren Buffett has owned Coca-Cola since 1988. Peter Lynch, that's me, made most of his money on stocks he held for 5, 10, 15 years. The returns didn't come from trading. They came from compounding, and compounding requires time and patience. Let me tell you what not to do. Don't check your portfolio every day. You don't need to. Nothing important happens in a single day. Stock prices bounce around. That's noise. It means nothing. Check your portfolio once a quarter. Read the earnings reports. Ask yourself, is the story still working? If yes, do nothing. If no, sell. Don't listen to market predictions. Nobody knows what the market will do next month, next quarter, next year. Anyone who tells you they know is either lying or delusional. I manage billions of dollars, and I never once successfully predicted what the market would do in the short term. Nobody can. The market is too complex, too random, too driven by emotion. But I could evaluate businesses. I could tell if a company was growing or shrinking. I could tell if management was competent or incompetent. I could tell if the story was working or breaking. Focus on the business. Ignore the market. Don't trade. Every time you sell and buy something else, you're making two bets. First, that the stock you sold won't keep going up. Second, that the new stock you bought will do better. Both bets have to be right for you to win. That's hard, really hard. Most of the time, you're better off just holding what you have. Here's a mental trick that helped me. Imagine you can only make 20 investment decisions in your entire life. 20 buys. That's it. If that were true, you'd be really, really careful about what you bought. You'd research deeply. You'd only buy companies you truly believed in. And once you bought them, you'd hold them because you only have 20 slots. You can't afford to waste one on a whim or a trade or a hot tip. Treat your portfolio like that, like every purchase is precious, like every sale is permanent. That mindset will make you patient. And patience is the secret weapon of great investors. The bottom line is this: investing is not about activity, it's about results. And the best results come from buying great companies and doing absolutely nothing for as long as the story works. That's the art, that's the skill, that's the secret. Doing nothing. Let me leave you with this thought. When I look back at my career, I don't regret the stocks I didn't buy. I don't regret the mistakes I made in analysis. I don't regret the bear markets I lived through. I regret the winners I sold too early. I regret the 10-baggers I turned into 2-baggers because I couldn't sit still. Walmart, Fannie Mae, Home Depot, the Limitless Store, dozens of others, every single one of them went on to become massive winners after I sold. And every single time, I sold for the same reason. I felt like I should do something. That feeling cost me billions, literally billions. Don't make the same mistake. When you find a great company, when you've done your research, when the story is working, when the business is growing, do something incredibly difficult. Do nothing. Just hold. Be patient. Let compounding work its magic. Because the real money in investing is not made by the people who are busy. It's made by the people who are patient. The stock market is a device for transferring money from the impatient to the patient. Be patient. Do nothing. Get rich. It's that simple and that hard. The art of doing nothing is the highest form of investing. It requires discipline, patience, and trust in your own research. Master that art, and you'll do better than 90% of professional investors, because most of them can't sit still, but you can.